Hi, so today we're going to look at another big, gigantic Chinese company, and it is often referred to as the Google of China. And for those of you who haven't been to China before, well, one of the first things you'll notice when you step off the plane is that all of Google's services don't work. And it's a bit of a shock, but Baidu is the company that fills the gap in the Chinese market. And if you're new here, well, welcome to my channel. My videos are about investments that anyone in the world can make. And something I'm really trying to do is help investors think a little bit differently, especially how they approach the stock market. I find that people do far more research into the next phone that they're going to get or a computer that they're going to buy than they do in shares of a company that they're investing in. So my plan is to take a good hard look under the hood of the company and to make sure that we're not buying a lemon. And hopefully I even help you save a little bit of time in your own research. And by the way, it takes me a few days to put these videos together, so if you wouldn't mind, all I ask is you hit the like button for me. Alright, now let's jump into the analysis of Baidu. Back in the year 2000, it was Robin Li and Eric Xu who came together and created Baidu. And today it is a mega tech company that is moving now into artificial intelligence, self-driving cars, and personal health. Baidu is the dominant search engine in China, commanding about 70% of the gigantic Chinese market. Having a popular search engine has opened up many possibilities for Baidu as well. Most of it is just monetizing through ads. Baidu have maps, image search, and a browser. Sound kind of familiar, doesn't it? And unsurprisingly, their advertising network, well, it works pretty much exactly the same as Google AdWords and Google AdSense. Now, back in 2007, Baidu actually became the first Chinese-based company to be listed on the Nasdaq stock exchange. This, I think, is an impressive feat, and it led a wave of Chinese tech companies listing on American stock markets to raise money. Now, I see this as a positive because they've had now 13 years on the American stock market to be scrutinized by all the analysts in that marketplace. The reason I think that's positive is because, well, Chinese companies, well, they have a bit of a reputation for fraudulent activities. So for Baidu to be going strong as an American listed company for so long now, well, it gives me reasonable belief that they're probably doing a lot of things right and they're probably not committing some sort of major fraud. See, a lot of investors will rule out Chinese companies because they have this stereotype that they're all corrupt or run by the government. Well, the stereotype isn't without its reason, but I think it's a big oversight by investors to paint all Chinese companies with the same brush. And just to get a feel for how important and big Baidu is, well, here are the top 5 websites in the world based on time spent on the website. Coming in at number 4, surrounded by Google, YouTube, Facebook, and Wikipedia. There's Baidu. Now, the other area that is interesting, and this is a bit of a follow-on from my previous video about Netflix, well, Baidu have a large stake in the company called iQIYI. And I'm sorry about the pronunciation there of this company, but it's essentially just the Netflix of China. And it doesn't stop there. They're actually a giant conglomerate with their fingers in lots of different pies. Now, this is really starting to sound a lot like Google and Alibaba and Tencent for that matter too. Now, this I think is very interesting. See, China's number of internet users is about 800 million people, which is double the size of the entire US population. And with China's population at about 1.5 billion people, well, that means there's still another 700 million people still to come online in China. That's right, about half of China's population isn't using the internet. So there is good growth opportunities in China alone. And we also have to remember that Google, which is probably the major competitor for Baidu, well, they're banned from the Chinese market. I have always thought it is crazy that the Chinese government can interfere like this, but I guess it is how it is, and it doesn't look like it's going to change anytime soon. All right, so I've talked a lot about the positives, but what about the bearish side of this investment? So firstly, I would reference the 2019 market share of Baidu. See, back in 2017, it was actually about 77%, and now it has decreased to about 70%. And more recently, it is reported to be closer to 66% market share. So Chinese companies are slowly but surely taking little pieces of market share away from Baidu. And with Alibaba and Tencent as their rivals, well, that's some pretty big time competition. The next bearish point that I have is that iQIYI and Baidu, well, they don't really work independently of each other. Even though they are separate businesses with separate stock market tickers, well, Baidu is the majority owner of iQIYI and they actually subsidize a lot of their purchases. Okay, what I mean is think of it like Netflix, and Netflix have to spend like millions and millions of dollars to buy the rights of a TV series, let's say 2.5 Men. And since Netflix is standing on their own 2 feet, well, they have to purchase this TV series with their own money. But if IQE wants to get a popular TV show for their Chinese market, well, Baidu helps them pay the bill. It's a strange situation, and it's something we're not used to seeing, where we have companies helping each other out. Now, Baidu aren't just doing this to be nice. They obviously see the growth potential of IQE, and as a major investor, well, they want to see that happen. But look, honestly, I think it's just kind of strange, and it's something I don't really like. I think companies, if they wanted to list on stock markets, well, they really should be standing on their own 2 feet. But hey, I guess there's more than one way to cook an egg. Now, on top of this, you've got the current US-China trade war, you've got a slowdown in the Chinese economy, and we have all this lockdown stuff happening. Well, advertisers have been tightening their wallets. So with the increase of spending for IQE and the current market conditions, well, it's been financially quite a tough little period for Baidu. But maybe this will give us some sort of opportunity. So I think it's probably a good time now to go through their finances and see what we see. Now, there are 3 key areas to the health of any business. We want to see whether they can handle their debt, are they growing, and are they well managed? Now, of course, just sit back and don't worry about the terminology. Just try to get a feel with what is going on here. First, we're going to look at whether they can handle their debt. And this is really important because if something was to go completely wrong with the company, like a crazy government decision, and their business was to completely stop, well, if they have a low level of debt, well, they're going to get through this period okay. See, high debt companies in this situation, well, this is where they go bankrupt and this is where you lose all your money as an investor. So to see if the business can handle its debt, I went through the debt to equity ratio and the current ratio of the business. And for Baidu, well, the debt to equity is looking good at about 0.4. Now, I want to see it under 0.7, so I was a little surprised. I thought they might be in more debt since they are funding a lot of IQE's content purchases. So this is better than I expected and a good sign. Now, this is the current ratio, and I'm looking here for above a 1.5, and Baidu is nearly at 3. So they are handling their debt well, and they don't have any short-term concerns. Next, we're going to see if they're growing, and if we wanted to compare Baidu with Google, well, we're definitely going to want to see some really good, strong growth here. So in the finances, to check for growth, I look at the book value per share, earnings per share, and operating cash. Okay, so this is the book value per share graph, and this is the growth we wanted to see. It is consistent and improving. It does look similar to Google's book value per share as well, so a great sign so far. Now, this is important. See, 2019 was a tough year on the company, and I would expect the share price to also have had a tough 2019. We'll check on that a little later. But this, from my research, is because of the heavier investment into IQE, helping them fund the content. Also, an increase in research and development in artificial intelligence, self-driving cars, and there's also a far weaker Chinese economy. So what I really think is that it is a tough time for Baidu right now, and it is clearly shown in these graphs. But with the impressive past history, well, a speed bump is actually okay to see. It's not ideal, of course, but I don't want to rule it out completely since they have that great book value history. Now we'll take a look at whether the company is well managed, and we can't just go in and sit in with the management team and hear what they're saying in their meetings, of course. But there are some telltale signs in the financials that will give us the hint that the management team are making some good decisions. So I'm going to check the return on equity, the free cash flow, and the cash on hand. Okay, this is the return on equity, and this is a concern. I don't like seeing return on equity declining like this at all. It means that the decisions that the company are making are not paying off at the moment, and this is a red flag. Okay, so the free cash flow is pretty obvious that Baidu has upped their spending in the past few years. Again, this has a lot to do with IQE and their research and development. Now, this is the cash in their bank. So it is growing, which is a really good sign considering they are investing into things so much. This means that the company, well, yes, they're investing in their future and new projects, but not more than they can handle. They are preparing for the longer term by building up some cash reserves in the bank. But still, I have to give it a cross here because I just don't like seeing such a low and declining return on equity. So what I'm going to do now is I'm going to use my intrinsic value calculator. Now, if you want a copy of this, it's free and it's in the description below. And what the goal of this calculator is to do is to find the prices that we would be willing to pay to give ourselves also a good margin of safety. So here's the data that I've entered into the intrinsic value calculator for Baidu. Now I've used 9% as the growth rate for the next 5 years, then 7%. Now I found that by looking at what the analysts are predicting. Then I want my return on investment goal, with this is also including a margin of safety. So I use 20%. The multiple is 12. Now that's a fair multiple that I could sell it for after 10 years. Now I've already went and found the operating cash minus maintenance capex number and the shares outstanding. And it says that I should be buying at about $107. Now I actually want to be a little bit more conservative in this number. So I've actually put in the information for a better margin of safety where I've used 22% as my discount rate, plus I've used lower growth rates. And the price that I wanted to buy it at now is about, call it $95. Now this doesn't mean I'm actually going to buy the company if it does hit $95 because as you've seen earlier, well, it's the return on equity that I don't like. And now we have a look at the current share price, which is $125. So even if I was interested in buying Baidu, well, it is still above what I'd want to be paying. So do I think Baidu is a good company to invest in? Okay, so I went over a lot of points today, so let me put all that together. So let me start with the negatives. Now, I don't like how iQII has such an impact on Baidu's business. And just so you know, iQII is making a loss, and I think it's still an immature company. Market share is also slowly shrinking, but it is still a very dominant company. There are lots of current economic issues floating around the Chinese and world economy, putting pressure on businesses to advertise. I really don't like bad return on equity as it signals that the company hasn't been executing its plans. Now for the positives, well, China's internet user base has a lot more growth in it. We are talking about one of the most used websites in the world. They are one of the most mature Chinese companies, and investment in Baidu is really an investment in China. They have lots of different avenues that the company can use to grow. Artificial intelligence, self-driving cars, and things like that. And the long term does seem more positive. They have a strong position in their core advertising business, so they can take advantage as China's confidence returns. I actually really like the company in general, and I think they're in a really good position to take advantage of the future of the Chinese economy, and I think there's a lot more money to be made. But for me, right now, I just haven't seen enough in their financials to warrant an investment at this time. And this is mostly due to the poor and declining return on equity graph that we saw earlier. I think Baidu, well, I think I'll need to reanalyze the company in about 1 year's time. By then, we'll have a little bit more information about how their plans are coming to fruition, and we'll hopefully see some sort of positive sign on their return on equity. I do think they have interesting potential, but honestly, I think investing in Alibaba and Tencent is a better play into the Chinese market. Anyway, there are plenty of other investments out there that we can look at, and hit subscribe if you enjoyed this analysis, and I will see you in the next video.